Welcome, everybody, to the Chinchilla Pickin' Podcast. It is September 21st, 2022, 4:03 p.m. The markets have just closed. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I am here with Brandon Beaver. Brandon, how are you, man?
My mic is turned on and it is plugged in. And so I'm going to talk like this for the rest of the show. It's going to be super soothing.
Thank you.
Kind of like NPR.
If you could just put your mind in a calm space right now and close your eyes, I want you to imagine a field, lots of flowing reeds in it, and the wind and the blue sky. No, this is stock and investment, Brandon.
Today we're going to talk about the migration patterns of cicadas.
We are not. No, not unless there's an investment to be made off of it. I will tell you this. Look, all right. I don't give many shout outs, but I will give a shout out here to I started a new workout group and routine with F45 training here in Cincinnati. And the guy who owns the local franchise, his name is Horrell. I think I'm probably butchering his name. Jarrell. I'm sorry if I'm butchering your name. Please do not take it out on me next session. But great guy. If you ever want to have all your muscles in your body be sore at once, please go to a workout. It's you will achieve that goal in life. It is killing me, but I am enjoying it at the same time. I don't know what's wrong with me.
Cicadas live in the ground and then they come up above the ground every 7 years.
And you thought we were going to talk about stocks and finances and investments here. You were wrong. So seriously, Brandon, I want to talk about what happened Saturday. So if anyone, because there was a couple of issues, and I want to first of all apologize. I want to start off by saying that Brandon and I are nowhere proficient in IT, hardware, setup, streaming. This was our first ever attempt at doing this type of thing. I think we did. I would give us a good grade. I would give us a passing score. I would say we probably did 75%, maybe an 80% if I graded myself.
I'm pretty well proficient in software and Excel and stuff like that. But the hardware, the stuff that requires, that kind of attention, not so much.
Right? I mean, so my laptop crashes. We're using your laptop at that point. We had to switch all of a sudden. And if you saw us, some people had trouble seeing us on Instagram. We started doing Facebook Live via Brandon's Facebook on Facebook in that way. And then for recording the podcast, one of us, I will not name names, forgot to hit record.
No, I did hit record. I just hit a different button in it unrecorded.
Brandon, that's not what the cameras at Starbucks showed, okay?
But there's a bunch of different recordings on there that are like segments and like 1 minute and 30 seconds of us talking, and they just end. And I
think it was the internet. I should have ran the hotspot. I forgot to bring a hotspot and run it off of that. It was the internet, and I apologize. So if you heard it, it was a mess. We apologize. That was our first attempt. We're going to get better.
Yeah,
we will get better. So, we will learn from this and grow and move forward.
If I can figure out a way to separate the audio from the video and get it uploaded as a podcast, I'll do it as a bonus episode this week sometime. The audio is not going to be that great on it because it was kind of loud at Starbucks, but you know what? They were very, very generous. I love the fact that the one of the guys came up to us and said, "Hey, is it okay if I run the coffee grinder? And it's going to make noise." That was really cool of them. They didn't have to ask us that, and they didn't have to reserve the table either. So big shout out to them over on Union Center and Floral Drive in Westchester.
Yes, Union Center Floral. You make sure we say that. But yeah, a lot of people saw the banner. A lot of people were watching us, staring at us. It was weird having people like just 2 feet away staring at you as you're trying to record a podcast. That was the first time for me, but I actually enjoyed it. I didn't feel uncomfortable. It was different.
And shout out to Megan Brown too for making the graphics that we use here on a daily basis in our episodes and weekly basis, and on the banner too.
Yep. Thank you, and Megan Brown.
That we have. I mean, I get compliments on the stuff all the time. So, and it's not even us that did it; it was her for free.
Great person. Yep. All right, let's get into the show. Rules. Everyone, who listens to the show understands the rules. Brandon and I get together 5 to 10 minutes before the show. Today is probably like 2 minutes. And we tell each other what we're going to talk about. We do not discuss it. I will say today, Brandon was listening off, and I was forcing him just to tell me and not start talking about it because he has a bad habit of trying to do that. And I will give you guys, if you're listening right now, do not tune out. We are going to have some argumentative discussions because some of the things he mentioned, I disagree with, but we did not discuss it. So you get to hear the live argument back and forth. So please listen to this whole podcast. It might get fun. It might not. Who knows? Brandon, since you had the majority of stuff, you go ahead and take the lead. Where you want to go?
So we got another 75 basis point decision by the Federal Reserve today. And the question that I have to say, the question I have to ask is, are we at a tipping point? I've discussed the business cycle on this podcast. In the past, we have an entire episode dedicated to it. And I mean, there could not be enough signs that we are at a tipping point right now. Inverted yield curves, Fed's raising rates pretty drastically compared to where they used to be. Ford giving a $1 billion profit warning, saying that their profits are going to come in $1 billion less than what they were because the supply chain situation. Go ahead, Dave.
All right. So since you brought up Ford, let's talk about Ford for a minute. I don't know if you did any research on Ford or if you're just using this as fodder to feed your overall reaching point of, hey, we're on a tipping point here. Ford's $1 billion is the extra cost it incurred to make sure it got its parts and supply chains in. Here's one thing I want to mention about Ford. I'm looking up the stock currently as I'm talking right now. So Ford, I believe it was 2 days ago, Ford lost $11 billion in value of the stock going down, correct? If I'm wrong?
Right.
So they lose that much value. However, they said that they only saw a $1 billion correction in the numbers. Yeah. So why do you lose $11 billion in value? To me, that means a company that has been oversold and looks to be a value company now.
I think it was overbought.
I no. The F-150 Lightning, the EV vehicle, this is where we're all going. Ford is still competitive now in California because they have the EV truck. They're coming out with the Mustang. They're coming out with other electronic vehicles. They have a competitive edge. And now that they spent that $1 billion to keep their supply chain up and running and going, now they have that initial investment. It's already worked into the numbers. We're already expecting it. Now we're going to see some more higher profits going on later on here.
Well, not in the short term. $3.7 billion in adjusted earnings before taxes and interest last quarter. This current quarter, now we're looking at $1.4 billion and between $1.4 billion and $1.7 billion.
Yeah, that's that $1 billion. That's that $1 billion ish that they said they would be down. Now, as short term, what define short term for me? Because I'm actually looking at Ford as a possible value play here. I'm completely opposite of you on Ford. Completely opposite. I couldn't be more. I'm getting heated talking about this right now. But what do you mean by short term? What do you mean by short term?
Next 2 to 3 quarters.
2-3 quarters? Yeah. No. I would have given you months. I would have let months. I would have said, okay, I could see months because the overall economy is going to take a hit. The overall stock market's going to take a hit. I could see the next 2 to 3 months, but not quarters. No.
I think the next year, the stock market's going to be taking hits.
All right. So apparently I turned into a bull, and Brandon, you're still playing the bear role here.
That's fine because we've came down with quite a bit. A lot of stocks down 50% or more. So it's okay to be a bull right now, especially if you've got long-term time horizon on it. But
whoa! I didn't say I was a bull right now. Remember, I'm calling. We're still going to go a little bit lower. I'm still saying we're going to go a little bit lower. That's why I said I'll give you 2 to 3 months, but I'm not going to give you 2 to 3 quarters. I believe that the stock market will bottom out here soon, and there'll be opportunities to start slowly buying in like we did earlier this year when we made a lot of money. And I'm waiting for that opportunity, and I'm eyeballing Ford Ford's up today. If I would have bought it when I saw those numbers, when I saw it crash the other day, and I bought it today. Let's see it was up at 3.75%. That would have been a nice daily return because of off the bounce. You could have said that's a dead cat bounce. Maybe you can make that argument. It was a bounce nonetheless because it was oversold, and a lot of other people saw it.
So I don't think the stock market's going to bottom, and I'm not going to start buying until I sense that the Federal Reserve is going to start slowing their quantitative tightening and their interest rate increases.
So both. You need both of those to go into effect because I don't want them to slow quantitative tightening. I want to completely tighten until they're not doing it anymore. I want to get rid of quantitative easing altogether. But as far as the interest rate, if they just get rid of quantitative easing, that alone will put the economy where they need to put it.
And to be clear, we don't think that they should do that now. That's just what we want to see, and we want it to be reasonable that they're doing it, and we want inflation to be conquered, or at least it looks like that it's going to be conquered, and it looks like they're going to start to ending their quantitative tightening and slowing the pace of increase.
Yep.
So we don't want it to happen now, but that's what we're looking for in the future. The Federal Reserve, it looks like they're going to actually wind up raising their Fed fund rate to 4.6%. And I think right now we're around 3.15% or around 3%, somewhere around there. So we still got at least 100% or not 100%, 100 basis points left to go. Dave, I'm telling you, I see 20% downside in the S&P 500 as a very good possibility, and a 40% downside as a small possibility. Go ahead.
All right. So you and I have had personal discussions one-on-one about a possibility of analysts. There's been analysts on CNBC, on Bloomberg, and all these calling a 3,000 S&P level. And, in the past, and I'm talking about the past week, you have been hesitant to say that it will go down that low. And I've been saying I don't see it going down that low. Maybe I'm the one who's completely wrong here. It wouldn't be the first time I've been completely wrong. Probably won't be the last time I'd be completely wrong. But I can't see it going that low based off this news. But at 20%, that's getting close to 3,000 level on the S&P.
Lower.
Yeah, I mean, why are you seeing it at that rate? Because we've already come down, and I know we're going to come down some more.
We still haven't tipped in inflation. We're still like the last readings came out higher. And, we've already slowed global GDP. We've already slowed, as all the central banks are kind of doing the same thing in tandem right now. And the United States has already seen 2 consecutive quarters of declining GDP. We haven't seen that hit the job market yet, and we will. It needs to happen. We will see it hit the job market. So I just don't know how bad that's going to be. So that's why I say 4%. We've already seen in the past year, and we've talked about this before, how bond rates and treasuries and stuff like that affect the stock market. They move inversely. As rates go up, the stock market goes down, generally speaking. And if we have another 1% or more, or 1.6% even to go, that's another 20% drop for me. Go ahead.
Let's reverse this. What you just said, that we haven't seen the job cuts. I mean, are you kidding me? I mean, have we not seen already job cuts?
7% in unemployment, 3.7%.
Well, yeah, and I've explained that away. I've explained why we're still seeing that.
Yeah,
we are seeing job cuts. We continue to see job cuts. Meta announced job cuts again today.
It's going to get worse.
How many more job cuts are you looking for? I mean, are you looking for like the whole unemployment number to go up?
Yes.
Because there's a lot of people now that are doing side gigs, or a lot of people that are doing like podcasts now for money that don't count as quote unquote jobs. There's a lot of people doing these type of freelance items that aren't counting as jobs per se, that that's what they're doing for a living now. And there's a lot of people in the over 50 that, I got enough to live off of. Let me just go ahead and retire now. And they just retired. There's a lot of that you're not taking into account, I believe, that has happened the past year. And, I'm looking at this economy. Yes. Do I see more job cuts out of major corporations? Yes. But I'm not going to expect the job cuts that I feel like you're trying to say is going to happen. I think that you're going to have fewer. There's going to be these companies that are no longer hiring. So the Meta is like doing this 10% cut, right? They're not going to be hiring anymore. So no one can just go into Meta and just get another job, or then they can't go to Google and they can't go to Apple. So now they're like, oh, now I'm really just out of a job. Right now you can still go to some corporation or company and get a job, especially if you're a software engineer. A lot of companies are still in short need of software engineers. That's something that's always going to be there right now as a job if you have that skill set.
I don't think that they're going to be there in the short term anymore. I think I think it's going to be tough. Small businesses are going to be worse. The Small Business Administration, they said that loans could rise to above 9% by the year end if the Federal Reserve continues to raise rates in its battle against inflation. That's bad for small businesses. It's going to be really hard for them to cover the cost of paying back their debts and doing business at the same time.
They have to raise their prices or cut costs. That's their only option. I mean, and we're already seeing prices going up, huh?
And that would be cutting jobs as well, probably.
Well, I mean, yeah, it means these small businesses, the owners are going to be working 70, 80 hours to keep their business afloat because, some of them are not well ran and they don't actually pay themselves a salary. So they're just going to sit there and work forever until they can get enough income coming in generated. But, I disagree with you on where you're saying on where the S&P's headed.
Yeah, and let me say this one more. Let me say this one last thing about the small business loans. The CEO and founder of Fountainhead, which specializes in small business lending, said that demand for lending hasn't changed yet, but we're getting dangerously close to where people will start to second guess. We're not there yet, but we're closer, which means to me, we haven't bottomed as an economy. And I don't think that the stock market is pricing in a potential hard landing.
We haven't bottomed as an economy because of companies like Affirm. Hear me out. So you have a middle-class family or a middle-class household income family, and they're over there and they want to get go on vacation or get a new TV or a new sofa or something. There's all kinds of lines of credit now available for people to go ahead and extend this and just make the minimum payments. And so people are still purchasing, but they're overextending themselves and overextending their budget. And that's going to be a problem. What you're going to see, and this is what I talked about in the last podcast. This is what I'm looking for. It is you're going to start to see all these things tumble if what you're saying is true. I don't believe what you're saying is going to happen, but if what you're saying is true, and that is what's going to happen, what you're going to see is companies like Apple's credit card. It's going to be one of the first cards to tumble, meaning they're going to see rates of people not being able to make payments on their cards happen very fast, and it's going to end up failing. And you're going to see the same with Affirm, and Affirm's going to drop out because people just can't make the payments, and so they just quit. And then you're going to see collection companies, start to gather more and more business, and you're going to see all kinds of things happen in that realm of the U.S. So, I mean, that's what you're going to see first. And if what you're saying is true, Brandon, that's what's going to happen. That's the signal that, hey, you need to sell and get out of this market because it's going to drop and you don't want to be sitting there holding it. You want to be buying, have cash on hand to buy when things bottom out.
That's
now,
why
I disagree with you.
Okay. Yeah.
I disagree with you. Now I know what to look for. I know the signs to look for, but I disagree that we're going to get that far. Do I believe we're going to have more downside? Yes. Do I believe we're going to have more downside for the next 2 to 3 months? I'll give you that at most 2 to 3 months. But after that, in the market, we should see some sort of plateauing. It shouldn't continue to drop.
This still smells crashy to me, personally.
I'm not going to convince you, am I?
So the Federal Reserve is, and you're convincing me that you could be right. We'll put it that way. But the Federal Reserve, they're reducing the amount of bond holdings that it's accumulated over the past few years. That's what they call quantitative tightening. It'll be $95 billion a month in proceeds from maturing bonds. that they're going to be selling off of their $8.9 trillion balance sheet. Go ahead, Dave. After you talk, I'm going to give a way to make money off this.
All right. I know where you're going with the giveaway to make money, and that's something that we don't disagree on, but I want to hear you explain that. So before you get to that, yes, they have been trimming their bonds, but they've also said at the beginning of this year they were going to start trimming their mortgage-backed securities they were buying, and they haven't. I reported this on the last podcast. I gave the numbers. I pulled up the economic outlook calendar that you can find on Fidelity. Anyone has access to it. If you have a Fidelity account, you can access it. And you could go in there and you can look at the week over week holdings of how much mortgage-backed securities the Federal Reserve has. Their total holdings have come down, and it's all been with bonds, but it has very little tightening on the mortgage-backed securities, and that's a problem I have. If you're going to do tightening, I want to see it all the way around. I want to see us cut back on how many housing bonds we're buying from banks, because then we're propping up a housing market that doesn't need to be propped up right now. We're propping up a housing market. People are overextending on their personal income and households, but wages are also going up, Brandon. So I mean, right now it's like it's not really hurting them. And that's where you're saying, like, as soon as the Fed tames inflation, wages will come down, and then that first domino falls. And I get what you're saying. I get your point, but I don't think we're going to see that.
Yeah, you know what? I don't think it'll be necessarily a financial recession. At least I hope it won't be. JP Morgan has probably about $1 trillion. That's what Jamie Dimon said at the congressional testimony that he was given yesterday. It's about $1 trillion. They can't deploy it though, because there's too many regulations regarding how much capital they have to have on hand. But it does look like, most of the banks at least are relatively safe for now. I mean, $1 trillion for JP Morgan sitting on the sidelines, it's not a bad deal for them. But he did say he was crossing his fingers that we don't have a hard landing. He did not seem like he was very convinced that we weren't going to have a hard landing. He warned that the Federal Reserve needs to continue to raise rates because we're facing a potential stagflation situation. And then he said something else that caught me off guard, because nobody else in the mainstream has said this. He said that this inflation is being caused by too much stimulus in the system. And he's absolutely correct. 100% right.
He is absolutely correct that there was too much stimulus that caused this. Even Steve Leisman, someone who has 100% backed the current administration, that he is 100% backed, has said, hey, we overspent our way into this. We cannot overspend our way out of it. Yeah. And this is someone who's been in favor. And so, I mean, you're looking at unbiased views from strictly an economic standpoint. Yes, overstimulus has caused us to come to this point. That's amazing. They got $1 trillion in cash, because how many banks would that have bailed out in 2008?
What other company has that? That's insane.
That is
Apple.
crazy.
Apple's like 90 billion.
And that's what they're required to hold in cash, right? So that they can withstand a horrible hit to recession, so the government doesn't have to bail them out. Yeah. That is crazy. You knew what? The government made money off of some of their bailouts. To AIG had to pay them back everything that the government lent them and then some. So the government made money off of some of those bailouts.
Yeah.
How do we make money? How do we make money off of this, Brandon? That's what I want to hear from you.
Go to the Federal Reserve website, federalreserve.gov, I think it is. Look at their balance sheet, and then you can see what they're unloading, and they're unloading treasuries and they're unloading bonds. And then you can go and I will post a link on the show notes page for inverse bonds and inverse treasuries. And this is a short-term deal right now, right? When bond prices go down, the interest rates are going up. So we're actually, in the short term, we're betting against bonds, but we're betting on interest rates going up. And that's what's going to happen, because $95 billion a month is coming off of the Federal Reserve's balance sheets, and it's going to be mostly treasuries and bonds. So you can actually make money by going to these inverse ETFs and buying one or two of them. Now, if you also are like me and you think the S&P 500 has more downside and possibly a lot more downside, you can go and underweight it, but still buy the ticker symbol SH, which is an inverse S&P 500 ticker ETF, And but the reason why I say underweighted is because these are volatile. So anytime there's a drop in the S&P 500, these things tend to shoot up pretty high. So you don't need to overweight it and take too much risk in order to make a decent amount of money off of it. And I would say the same thing about the inverse bond and treasury ETFs. So or inverse TLT. The TLT actually is betting with bonds, but in the long term right now, if we're looking at a long-term play, there's not much to recommend in the stock market right now. I still like Disney, and we'll talk more about Disney in the coming minutes of this episode. But there's not much. I mean, what are you going to do? I told people at the beginning of this year, and you did too, to go into consumer staples. But now people have piled into consumer staples to where they're so overcrowded that their earnings are just in a pipe dream land somewhere. I mean, who really thinks that Clorox is going to grow into its current multiple? The price to earnings ratio right now in Clorox is 38. Apple is 24. Do you think Clorox is going to grow 38 times?
No.
Anytime in the near future, even in the next 5 years, it's not going to happen. So that's got to come down too. So my thing is, I just, I'm on the Money Vikings Discord channel, and Jerry sent a message out, and we were kind of on the same wavelength because I was having the same thought that he was, and he just didn't know it. Neither did I. But he sent a message saying that he was on the phone with his broker trying to buy some 2-year treasuries. Now, I think personally a 7-year treasury might be a little bit better and might be a little bit safer, but 2-year top 4% this morning. And, that's lower than inflation right now, but still 4% is not bad. What you're getting the S&P 500 right now, we're still down like 15%. So at least you're holding on to some of your cash. And then second of all, the point of that is that I think deflation will probably be lower than 4% sometime in 2024, 2025. So I would go 7 years out instead of 2 just to play it safer. But, a treasury right now, if we have a hard landing, is a good deal because those treasury prices are going to go right back up if we have a hard landing, and the interest rates are going to go back down, and you're going to be in an even better position because you'll be able to trade out of them if you want. Now, I said bonds were dead when we first started the show, right? And they were because interest rates were sub 1%. Who's going to go ahead and buy a bond right now at sub 1% with inflation nearing 9% right now? Those are worthless, right? But we're getting to a point right now where economics are completely different. Go ahead, Dave.
Wow. Just all right, man. Look, a couple things unpack from everything you just said. First thing I want to unpack is you just said deflation in 24, 25. That's a couple years out, man. We're not in the same type of federal regulation as we were in when we came out of high inflation in the early 80s. We have a different group of people running it. And right now, Powell is the head of the Fed, and he's running things hard and fast. So we're going to see fast falls and fast rises. We're not going to see the years drag out and do it in a nice, safest way possible.
Hold on.
Situation. Go ahead.
He himself is not forecasting being back down near 2% inflation until 2025. But if he runs it too hard, it'll happen a lot faster. And I'm not certain how much I put into their forecasts right now because they've been really wrong in the past 2 years, like really, really wrong. And
yes. We actually agree on that right now. That's the one thing we agree on.
He's actually also forecasting a very moderate increase in unemployment. Very moderate, almost mild increase in unemployment, and I don't see that either. I
actually agree with him on that. I don't see the high increase in unemployment that you're calling. I see a moderate increase in unemployment. I don't see it breaking at all. 5%.
So to be fair,
5% is the max. Is a limit.
But 3.7% to 5%, that's a large percentage. That could hit the market hard. But it's not in the overall history of recessions. 5% is a footnote. You're right.
Yes, and that's what I'm talking about. All right. secondly here, I know you glazed over this, but I'm not going to allow you to glaze over this. I'm going to call you on it. I'm not going to allow you to just brush it off, make a comment, and move on past. No. For someone who spent one of our whole podcasts basically just down in bonds for a whole podcast. Yes, things are different, but then all year long, I kept asking you, are bonds still dead, Brandon? And you said, yes, they are still dead. I don't see them happening. Will you admit that, all right, bonds maybe aren't still dead?
Not now. So they're coming back alive. I think, with the $95 billion of Federal Reserves rolling off of the off their balance sheet, I think the bond prices will continue to go down for the short term. But if you're buying I would rather have 4% right now. I know inflation is like double that, but I'd rather have 4% than have an S&P 500 index fund in the next few months.
You have an S&P index fund, and you're talking about buying a bond. You're talking about having both.
So let me explain why. Because my time frame for this is 20 years out. And I said this in the past. Is there anybody that's listening to this that doesn't think that the S&P 500 is going to hit new highs sometime in the next 20 years? If you were like 99% of people that are listening to this, and maybe even 100% of people that are listening to this, and you think that the S&P 500 will hit new highs in the next 20 years, then there's no reason to sell it. So the time frame there is it's different.
So it's a long-term play that you have no interest in selling anytime soon, and that's why you still hold SPY. But you're looking at the treasuries, and for you have a medium time frame, which is 2 to 3 years out on your treasuries.
Yeah.
All right. See, we work in different time frames here, because when I say short term, I'm talking about like I'm holding that for a day or two.
Yeah.
And when I say medium term, for me, that's like 2 to 3 weeks, maybe a month.
Yeah.
And when I say long term, those are actual investments where we both agree on what a long term investment is long term, years and years is how I look at those long term investments. But so our time frames are different, which is why I always have to ask you about time frames. That's why I ask you, because when I say medium time frame, I'm talking basically a swing trade, versus when you say medium time frame, you're talking like it could be even a year and a half. I mean, that's just. But I mean, yeah. So yes, I'll say it for you. Yes, you were wrong that bonds were never going to stay dead. But I commend you for changing that based off of the actual microeconomics.
Now, the bonds that you bought a year ago, what are you going to do with them?
Who was buying them a year ago besides
You're
US?
conserving some capital with a very small amount of interest that you got, but you're still losing purchasing power on them to a great degree.
China's increased their bond buying from the US. China's increased their holdings of US debt. Japan has decreased.
There's probably some political reasons to that, though.
Probably. And Japan has decreased the amount of US debt they're holding, which is interesting as well. So,
and Great Britain was picking some up too, like a few months ago, and yeah.
I mean, if a country can make 4%, off of the United States, why not? I mean, we're considered one of the top, not the top, but one of the top safest country government bonds, if you will, out there.
Yeah.
I would not say we're the top at all. There's other countries that are well more secure.
But there's a lot of countries that have made the same bad decisions that we've made, but they've made them to a greater extent.
That's true.
And that's what kind of continues to bail out the United States and our bad spending habits, is that other countries do it worse than we do.
So we're not good. We don't do it as bad as other people.
We're just better than the terrible.
I love that. Oh man. Yeah, so this is what we're taking out. All of it is what you call a inverse bond ETF.
Inverse treasuries. Personally, I'd go inverse treasury probably for the next 2-3 months, maybe a little bit longer. Call your broker, see if you can buy a 2-year or 7-year treasury without having to buy like 1,000 of them, because some brokerages require you to have a minimum of like $10,000 going into it, and not a lot of people can do that. But you might be able to call your broker and negotiate a better deal for you. And I would just, you just hold it until deflation kicks in, because eventually it will. But that's why I'm recommending the 7 years, just to give yourself enough time to where that bond starts to increase in value again, because I think over the next like month or two, 3 months, maybe even, that it's going to decrease in value as the Federal Reserve unloads $95 billion worth of the stuff off of their balance sheet. And while that's happening, go with an inverse ETF and bet against the bond prices. That way you can make money with interest rates going up.
Look at you, man. It's like you're doing a credit spread.
Yeah.
You're doing a put and a call at the same time. I am not that smart. I am not able to do those type of things. That's why we have Brandon on the show to explain this. I am the John Madden. You buy it low when it goes up, you made money. That's how I am.
The other thing that you could do is you could just go value shopping in the stock market right now, pick out good companies, and just hold your seatbelt. Put your seatbelt on and hold on for life and wait it out. Disney Plus is going to be potentially by 2024 merging with Hulu. So Hulu is something that Disney owns around 65% of the company. The rest is owned by Comcast, and Comcast has agreed to sell its stake in the service by 2024 at fair market value. Negotiations, of course, would be going on for that to happen. The CEO of Disney actually wants to do this quicker than that, and he's wanting to negotiate with Comcast to have them sell their shares of it quicker. And he said, we would love to get to the end point earlier on this, but obviously that takes some level of propensity for the other party to have reasonable terms to get us there. And then he would be more than happy to facilitate that. And that was after saying we'd love to have full ownership of Hulu and integrate it into Disney Plus. This would give the merged companies 139 million subscribers at least. Go ahead.
A lot of people who have Hulu have that bundle where you get Disney Plus, ESPN Plus, with it. If you have the Hulu Live,
yep,
which I have Hulu Live, and they offered me this free bundle, which I've taken because they were going to charge me the same price anyways. So they said, look, you might as well just add Disney Plus, ESPN Plus, and all this other for free because we're going to charge you this price anyways. So I said, okay. But that's how I think they're getting a lot of subscribers, and I know they're eventually trying to start moving away from that. I think they're going to lose a small percentage of subscribers, but they expect that. I'm sure they expect that. I think where Disney's issues are with the parks. I think the parks are losing their magic, if you will. That's been a headline the past month. I've seen it in numerous news websites has Disney's parks lost its magic? So that's why Disney has focused on the streaming content, on making more TV shows and so on and so forth, and heading off in that direction because they believe that would be a good money-making part of the future of the company. And as I look today, if you're looking at the streaming services as a as the big, bringing in the profit year over year, I agree with you, Brandon. Disney would be a good buy. As long as the parks don't take too heavy of a loss, then I would agree with you on that. One thing I would be looking at, guys, is Showtime. So with all these like HBO Maxes and Paramounts and all these other companies that are out there that have multiple, like Paramounts with CBS and Paramount and other channels, right? I look at Showtime and it doesn't have a whole plethora of other channels with it. I look at that as a company that will probably get bought out because there isn't much to it with it. And another subscription service will probably say, hey, you know what? Let's pick this up and let's make us bigger so we can compete with the Disneys and the ABCs and the others and so forth. Comcast may use its money from selling Hulu to buy a Showtime or buy a smaller media company such as that. And that's what I would be looking at if I was Comcast, as a way to consolidate from the sale of Hulu that they've agreed to.
Yeah. Speaking of buyouts.
That was a hard transition there, buddy. Let's take a hard right now. Go ahead.
Nordstrom is trying to fend off a potential hostile takeover from a company called El Puerto de Liverpool SAB, which is a company that's based in Mexico. They recently acquired a 9.9% stake in Nordstrom. So Nordstrom went ahead and adopted a poison pill. Now, what a poison pill is a shareholder right plan. So shareholders' rights plans, and they're legal maneuvers that make it harder for other shareholders to build their stakes up enough to try to buy out the company. And so what they're doing is, if El Puerto de Liverpool SAB ups their share percentage to 10%, then Nordstrom will release a bunch more shares out onto the market to dilute the share price that shareholders have, and to dilute the amount of the company that El Puerto de Liverpool owns. And this is bad for Nordstrom shareholders in the short term. So if they or anybody else acquires a 10% or more in a transaction not approved by Nordstrom's board, then the company will automatically issue a bunch of shares out to make sure that this company no longer owns 10% of the company's stock. Now, Liverpool is saying this is it's a passive investment, that they don't want to own Nordstrom, but everybody that tries to initiate a hostile takeover in the history of any time ever has always said in the beginning that it's passive, because they don't want the company to know what they're doing. They don't want the company that they're trying to take over to know that they're trying to take over, because they don't want to have to defend against it. So if Nordstrom's going to get bought out in the future, just watch and see what happens. Watch and see if Liverpool ups their stake above 10%. And then once Nordstrom enacts the poison pill and sells a bunch of shares out onto the market, the stock value will then decline, right? But you also will get a better idea as to what Liverpool's motivations are. And at that point, maybe it is a buyout, and you can watch this and maybe look at it as an opportunity to get into, so that you can make some more money on it at that point, but not right now. Not right now at all. Did anything I just said make sense?
Yes, it all made sense. I'm listening to it. You caught me off guard with this one. I had to Google it real quick, look it up in my Fidelity app, and kind of take a look and see what it was saying about this event. When you first mentioned it, I was like, oh, it's this Ackman, it's this Icon. Who's going after it here? And it's no one big, no one that I've heard of before, at least. Well, maybe they are big, and I just never heard of them
They're
before.
big in Mexico. They own some upscale luxury brands in Mexico.
So it makes sense they want to take over Nordstrom as well. Nordstrom's a solid company during the Depression, recession times. They still maintain sales, and it's because they appeal to that higher end, like a Neiman Marcus and so forth.
Yeah.
And so those higher end consumers typically are resilient during tough times, and it makes sense that you would want to own this stock or buy this company out if you're Liverpool. But I don't know. I haven't done enough research. I don't know much about it, but based off your reason, if what you say is 100% true, I agree with you that would be the right approach. If you were going to play it, would be to wait till after they enacted the poison pill and the shares drop, then be looking for an opportunity to get in at that point in time. Yes.
And then I think Liverpool shows their cards at that point, because there's no way that they're going to force Nordstrom to enact a poison pill unless they are actually trying to plan a takeover.
Yep. All right, Brandon, is that time of the show, man? It's final thought time. Final thought, Brandon. You always go first, so go ahead.
Tough times in the market right now, and weird times when Apple is trading at 24 times earnings, and Microsoft is right around the same area, and Clorox is at 38 times. And then you just have to try to wonder where to put your money in. You kind of have to get really creative right now.
All right, I'm gonna pick on Brandon here.
Or you go long with a good company like Disney that's been beaten down a lot.
Right. All right, my final thought is first thought is Brandon is wrong. Bonds were not dead forever. Bonds were not dead forever. Second final thought. Brandon is wrong. Ford is a good value company, and I'm looking at it. It's on my watch list, and I'm watching it because I like their EV advancements. Am I saying buy it today?
When's it going to pay
No.
off though?
I would have said buy it when it first dropped 2 days ago. If we had the podcast in, I would have said buy it then, and you would have made 3.78% today if you would have sold at the height. If you would have sold right now, I think it's only up a percentage. Ford, I'm waiting for more downturn before I say it's a buy. I say add it to your watch list, keep an eye on it because I think it's oversold.
But that's what I'm doing too. But if it was but it's not oversold now, because if it was oversold now, then you'd be buying now.
So do the math, man. Do the math. It lost $1 billion. What they called was it bottom line or top line number? I think it was bottom line, was it not?
Bottom line, yeah.
$1 billion in bottom line number, but it lost $11 billion in value. I could do simple math here and let you know that, hey man, I think this is now, undervalued, and it, doesn't need to go back up 10 billion. No, but I mean, I can't. Is there some upside here? Yes.
I think it was reasonable because now investors are looking at this and saying, okay, what's in the future right now? If we do have a deeper recession, then it makes sense to sell it off more than what the value cut on it was.
No. Anyways, it's my final thought, Brandon. Brandon's wrong. No, he may be right. But take a look at Ford, guys. Do your own research. Take what you heard us argue about here in the show and research it. This is a good opportunity for you to see, hey, I researched it, did my own research, and I think I agree with, David. So you're right, or, I did my own research. I agree with Brandon. You would also be right as well, because it's your research. We're trying to give you guys the tools and how we come up with our process of finding what we like and what we don't like, and you guys end up doing the research yourself. So my final thought is add Ford to your watch list. Keep an eye on it. This is one I was going to bring up, but Brandon said he was going to bring it up, so I allowed him to do it first. Keep an eye on it because I think there's a buying opportunity here, but I'm waiting for a little bit more downside before I get it in, and that's just due to their EV markets there.
So is this a similar scenario when Coca-Cola in the 1980s came out with a new Coke and replaced, their old brand, and everybody went haywire and the stock dropped, and then Warren Buffett picked it up?
Similar, yes, similar to that effect, yes.
It's not the same scenario, obviously.
It's not, it's not apples to apples, but yeah.
Everybody's sour on Ford now, so maybe it is a buying opportunity in your opinion.
And that's what I'm looking at, and that's what I'm seeing, because again, it's the EV play here. And with a couple of states coming out saying, hey, we're going to move to all EV or hydrogen-based cells, going in the future, Ford's positioned himself to be strong in that category. Are they years behind Tesla? Yeah, everyone's years behind Tesla right now. Everyone is. Tesla's just running the field right now with this. But, I think Ford has positioned himself in a good spot. They have some good brands that people love. F-150 now, it's a F-150 Lightning. So, they got the brand name, they got the name recognition, they got what people are looking for. I think it's one you add to your watch list and watch it. I made the call last week on the video. I said, it's about that place where I say it took the heat. I said it was too high at 150, 160, I think it was 160, 170. I said it was too high and it needed to come down because there was too much bad news on it. It came down. Last podcast, it was around 130. I said, maybe now's the time to look at this, to build a position, start building a position in it. It's up now because of that. Am I saying, now's the time to build a position Ford? You can flip a coin. You can flip a coin right now on that. Maybe it is time to build position, but I say wait for more downturn before you get in. That's my final thoughts. As always, I hope we've been entertaining, educational, and uplifting, because we want everyone to make money. Have a good night.
Have a good night.